Welcome to the Microcap Brief. In a previous episode, we introduced you to the most important documents in investing, SEC filings. We called them the official captain's log of a company's journey, the unfiltered story they must tell, not just the one they want to tell. Today, we are going deeper. We're moving beyond just knowing what these filings are. We're going to teach you how to read them like a master navigator, giving you the complete toolkit to analyze a company's health, spot the red flags we've discussed, and truly understand the voyage you're invested in. First, the basics. The entire system is built on one word: disclosure. Publicly traded companies in the United States are legally required by the Securities and Exchange Commission, or SEC, to disclose meaningful business and financial information to the public. It's important to note that while most developed countries have a similar framework of disclosure, the specific requirements, timelines, and enforcement, especially in the US system, are particularly comprehensive to ensure investors have access to fundamental facts. So, let's open the logbook and dissect the most important entries, piece by piece. First, the Form 10-K, the annual map of the voyage. This is the most comprehensive report, filed annually within 60 to 90 days after the company's fiscal year ends, depending on its size. It is the full audited year-end summary of the company's entire operation. What to look for? Your first stop should be the business section to understand exactly how the company claims to make money. Next, and most importantly, read the risk factors. This is where the company is legally required to tell you everything that could go wrong. Then read the Management's Discussion and Analysis, or M&DA, which is management's narrative of the year's performance. Where to find the red flags? The 10-K is where you'll find the auditor's official report. This is where a going concern opinion, the most critical red flag we've discussed, will be explicitly stated. Next, the Form 10-Q, the Quarterly Position Report. This is the quarterly update, but it's filed 3 times a year for the first 3 quarters. The fourth quarter is covered by the annual 10-K. The 10-Q contains unaudited financial statements and is how you track the ship's progress between those big annual reports. What to look for? The 10-Q is all about tracking change. Compare the financial statements to the previous quarter and the same quarter from the prior year. Is the cash burn accelerating? Are revenues growing or shrinking? Check the Notes to the Financial Statements for any changes to the total number of shares outstanding. Where to find the red flags? A sudden increase in the share count between 10-Q filings is a clear sign of ongoing dilution. This is how you track the slow leak in real time. And most importantly, the Form 8-K, the Urgent Radio Transmission. If the 10-K and 10-Q are scheduled reports, the 8-K is the unscheduled, breaking news alert from major events. Companies are generally required to file an 8-K within 4 business days of a reportable event. What to look for? This is where the real action is. You'll see 8-Ks for financing deals, mergers, acquisitions, executive changes, and shareholder votes. Where to find the red flags? An 8-K is where a company must announce a NASDAQ delisting notice. It's where they detail the terms of a new equity line of credit or a dilutive financing deal. It's where they announce an acquisition and how they're paying for it. When you see an 8-K, you must read it. These 3 are your core toolkit. But there are other log entries every investor must know. We can group them into 2 categories: filings for raising capital and filings for disclosing ownership. First, the capital raising filings, which are your early warnings for dilution. The Form S-1 is the big one, used when a company plans a large public offering of new stock. The Form S-3 is a shorter version, often used to set up a shelf registration, giving the company pre-approval to sell shares quickly in the future. And the Form D is a notice filed within 15 days after a company completes the first sale of securities in a private placement with a small group of private investors. Next are the ownership filings, which tell you who the major players are. A Schedule 13D is filed when an investor buys more than 5% of a company with the intent to actively influence management. This is the activist investor filing. A Schedule 13G is for a passive investor who has bought more than 5%. And finally, the Form 4 is the insider trading report. Whenever a CEO, CFO, or director buys or sells their own company's stock, they must report it on a Form 4 within 2 business days. Are insiders selling? That's a major red flag. You can find all of these documents for free on the SEC's Edgar database. Edgar stands for the Electronic Data Gathering, Analysis, and Retrieval System. Just go to the SEC's website, sec.gov, and type in any company's ticker symbol. I highly recommend using the advanced search features to filter by filing type and date. It will make your research much more efficient. Your key takeaway is this: these filings are not meant to be read passively. They are an interactive toolkit. Learning to navigate them is the single most important skill you can develop. It transforms you from a passenger to an analyst. Your homework is to put this toolkit into practice. Pick one company you're interested in and go to the Edgar database. Open the latest 10K and read the Only the Risk Factors section. Find the most recent 8K to see what the last major event was. Look up the Form 4 filings for the last 6 months. Are insiders buying or selling? By doing this, you will know more about the true state of that company than 90% of other investors. Thank you for listening to the Microcap Brief. Stay sharp and do your homework.